Okay, all set, Lonnie.
Okay, good morning, everybody. Obviously, this is our first full board meeting of 2024. And as we know, some of our subcommittees have been meeting to really sort of go into depth in certain things, and they'll be giving us some recommendations for full board approval. And it's a jam-packed session. So, and I know at the end, there's some, some catching up to do and some things that some people are going to be able to stay around for, but I know there's a hard stop for a lot of people. So we'll try to move through this agenda quickly. Let's see, the first item of business, public comments. Do I hear any public comments or questions? No. Okay, so moving on to the consent agenda. I think there are 3 items on the consent agenda. Brian, do you want to get started on that?
Yeah, so we've got thank you. We've got the meeting minutes for December 15th of 2023. We've got 2 CPACE project extensions in Danbury and Milford, and we've got 1 under 500,000 and no more in aggregate than $1 million transaction for a CPACE project in Stamford at $490,000. So those are the 3 items on the consent agenda. And then we provided additional information on report outs per our under 100,000 and no more in aggregate than 500,000 staff approved restructurings or write-offs. There were no transactions, but we're just reporting out. We provided a progress to target update through Q2 of the fiscal year. And then we also provided our FY23 annual report, which is all the snazzy, flashy, picturey one on top of our 350-page plus annual financial comprehensive report. So those are the 3 items for resolution on the consent agenda.
Okay, are there any questions or observations? Do I hear a motion to approve the consent agenda?
I make a motion, Rob.
Thanks, Rob.
Second it, Hank.
Thank you. Okay, all in favor?
Aye.
Aye.
Opposed? Abstaining? Okay, thank you. Moving on. Let's see. So these are committee updates and recommendations. Who's going to get started on that? Brian, you?
Brian or Jane, do you want to give the APA report out?
Sure, I'm here. Good morning.
Good morning, Jane.
As of December 21st, the APA finished our report, our review of FY20 and FY21, and they came up with 2 minor recommendations. The first of which is that we had a lack of penalty of false statement language was missing in our contracts. So as of February of 2023, we have added that to our contracts. We did have language that protected us from false statements in case of default, but there should have been language that it is a Class A misdemeanor now in the state. So that's been taken care of, and that's been resolved. Next slide, please. The second had to do with our bond issuances. In our operating procedures, we have language that says we need to track whether or not we have any surplus funds from our bond issuances. And we had not done any issuance in the past and did not have a procedure in place to do that. We did 2 issuances in FY21 of the Green Liberty bonds. And what we did with those was we went back and reviewed the sources and uses and showed that they were equal. So we were not in violation of the operating procedure. And this is the procedure we've put in place to look at future bond issuances, whether they're Green Liberty bonds or something different. We did agree with both of the recommendations. They were minor, and we were happy with the results of the audit.
Excuse me, it's Bettina. You said there were only 2 bonds, but I think there are actually 4 bonds that were issued.
During the audit period, we only had 2
bonds issued.
Great. But yes, we have issued the 2 CREBs, and additionally, we had issued the SHREC ABS bonds.
Right, but they weren't concerned. They weren't concerned about tracking those.
No, it must have been something that didn't come up in prior audits, but we did
Okay.
go back and review sources and uses of those as well. And we are in compliance with making sure that
Awesome.
any surplus funds are transferred to the operating account.
Wonderful.
Yeah.
Thank you.
Yep. And we, as I said, we'll do this going forward with future bonds. We have received notification that the APA will review our FY22 and FY23 beginning on February 5th. So hopefully we'll be running through this again. It usually takes anywhere from a half a year to a year and a half for them to run through and report, and we will keep you apprised of that. Any other questions? Okay, thank you.
Okay, thanks, Jane. And then we're going to talk the Budget Operations and Compensation Committee. It's Brian. Oh, you're going to be there too, but Eric, do you want to get started? Who wants to get started?
I'm happy to jump on in.
Okay.
So let's start with the organizational targets. And before we get too far into the targets, I want to why don't we come back to this slide? So, all right. So starting with the incentive programs, organizationally, we're going to revise targets up, but we're going to cut targets in specific programs. So I'll start with the incentive programs here, and then as we talk about these targets, we'll jump back to a previous slide. So we are, the good news is we are increasing our SMART-E targets. We're going up from about 800 loans to 1,200 loans. We're going to $22 million in capital deployment. We're leaving the solar target about where it is. There's a little bit of uncertainty around solar and some of the innovations we're trying to do. I think our innovations would work, but we've had some recent issues with capital for change. Overall, these targets would have increased much further, but we were a little hesitant just with capital for change. We are expecting to see overall growth in the market just due to the incentives coming from the Inflation Reduction Act starting to hit the market. Now I'll pivot and start to talk about battery storage. So looking overall, our storage program, I think battery economics still remain challenging in many ways. We're looking to cut our targets on both the commercial side and on the residential side. We're moving down from around 250 projects on the commercial side or on the residential side to 150. We're scaling that accordingly on the deployment and the capacity. Similarly, on the C&I side, we have had much better uptake there, but we are rolling this back, and a lot of that is due to the fact that Pura has said, hey, when this block is done, which is expected to be towards Q4 of this fiscal year, they're going to relook at the commercial incentives. Sergio, did you want to get into anything in more detail around ESS?
Yes, sure. So some of the reasons we are experiencing low deployment, particularly on the resi side, is what I'm showing in this slide. Primarily is the absence of very important original equipment manufacturers, OEM, and TPOs, the third-party owners. I'm talking specifically about Sonova, Sunrun, and Tesla. Just to give you, put it in perspective, in RSIP, these three companies probably own 70–80% market share in RSIP. So we were expecting similar situation here in ESS, and they haven't joined, unfortunately. The reasons for that are several. One of them that I think is very important has been the existence of Connected Solutions. It's a competing project, offers similar compensation. They don't offer an upfront incentive, but on the performance side, is pretty much the same. They have less stringent requirements, etc. So as long as Connected Solutions is around, we're gonna have a hard time enrolling customers. Tesla participates in Connected Solutions. They have roughly 1,500 customers that we have asked them to transfer them to ESS, but that hasn't been possible just yet. We're in conversations with them. They have mentioned that the application process for ESS is just cumbersome, it's just too much documentation, etc. They're requesting a simplified application process, which is something that we are working on right now with the utilities and all these TPOs to understand, you know, what is the real need and what changes can be implemented. As Eric mentioned, the cost of the batteries is just it seems to be a little bit steep, and the upfront incentive seem inadequate for the actual cost of the batteries. When we launched the program, we expected a cost of less than $14,000. It happens that in reality, we are seeing that a battery system costs north of $30,000. So an incentive that was designed for an expected cost of $12,000 to $14,000 is just, you know, compared to $30,000, it's just inadequate. Another issue is the completion timelines of these projects, and I'm going to show you at the very end of this presentation. I'm going to show you a slide that shows how long it's taking for the large C&I projects to complete. And fourth is the capacity rights ownership, particularly for Sonova. Again, Sonova held probably a 40% market share in RCIP, and they are adamant that they want to own the capacity rights to be able to use these batteries in the NEPL, GIS, in the ISO New England markets, monetize these assets and make additional money. But this is something that Pura rejected. It has rejected it not only in ESS, but also in RS. There is a conflict there between Pura and Sonova. So until we resolve many of these issues, it seems that it will continue to be an uphill battle. Any questions?
Yes, I have a question, Sergio. Thank you for that. What is the impact to the LMI customer? I mean, there was a carve out in which 40% of this program must reach LMI community. So where does that leave them?
Yes, excellent question. I forgot to mention that. So it happens that a $30,000 battery is just not accessible by many customers, particularly low-income and disadvantaged community customers. The way to deploy batteries would be in these customer segments would be through TPOs, because they offer the lease arrangement, right? In which a customer, instead of paying $30,000 upfront for a battery system, they would pay, you know, an additional cost, minimal cost, $100, let's say, monthly for the battery, and that way they will get the resiliency that batteries provide. Well, it happens that these are the companies that provide the lease agreements. You know, it's the Posigen, Sonova, Tesla, Sunrun, and they haven't been able to join. Posigen joined, but they haven't totally started to deploy batteries. So it's been a problem. You know, we see that if we meet the multifamily, the low-income targets, you know, the 40% deployment targets for the program, multifamily affordable housing will be key for us to hit those targets.
Just an adder to Sergio, Brenda, I think later on, Bert, we're going to have Ben Healy from Posigen on the line. So save your question again, Brenda, and we'll ask it directly to a TPO focused on the low-income market. Great question.
Okay, thanks.
All right, so moving on to the financing programs, we're keeping targets relatively stable here. We're going from 515 projects just down to 509. CPACE is remaining flat. We've had great success with our own projects this year. The private market is a little bit slow, but we're keeping the CPACE targets ultimately where they were. On PPA, we're scaling back just slightly, just due to, let's call it, over optimism around developers bringing us projects. In the first place, we've cut those targets slightly. Everything else is remaining the same. Our capital and megawatt and capacity targets have been adjusted just in line with those PPA cuts. With that, why don't we move on and talk about the budget? So on the revenue side, we are just adjusting our revenues up to be in line with what has been received so far from the utilities for the Clean Energy Fund. Moving on to expenses, we have a couple of adjustments here that I will attempt to walk through. So let's start with marketing. We have an additional $50,000. This is primarily to support dues to the Coalition for Green Capital and all the great work that they're doing around the Greenhouse Gas Reduction Fund, which our membership there should literally be paying dividends in the form of low-cost capital once the awards, or I should say, knock on wood, once the awards for the Greenhouse Gas Reduction Fund are announced in March. Moving on to research and development, we have an additional $100,000 here to support a battery and solar end-of-life study that we are currently working on. We are working with DEEP and others on that, and that ties into some of the work that we're doing on waste and recycling on the environmental infrastructure side. We also are supporting some work that we're doing with the Bridgeport Communities LEAP and a community benefits agreement that's being put in place there. Moving on down to consulting, we have an additional $180,000 of this $230,000 is for support of our carbon markets consultant. We have seen massive growth in that project. We've gone from doing about 5,000 tons the last time we filed 2 years ago. We are working with our auditors right now, and our numbers are about 20-fold of that, and we still have additional markets that we're trying to bring in here. The revenue will cover this additional expense by far. There's an additional $50,000 in here to support some technical enhancements around SmartE that will help that program scale, ideally at an exponential level, as we think it's poised to, with everything that's going to flow Inflation Reduction Act and Greenhouse Gas Reduction Fund monies wise. Those technology enhancements range from process enhancements in the engine, the primary tool there, to employing a language model that'll help for some of the project review. So think about, like, how do we scan contracts between contractors and homeowners to make sure that they are delivering what they say they're going to deliver, as well as looking at how do we implement tools such as instant pre-approval and a common web-based application for the loan. So those are the primary asks there. The other ask here is headcount related. So we are requesting an additional 7 headcount, 4 of which are contingent. Let me speak about the non-contingent first. First is a headcount associated with Smarty and the implementation of new measures and the technology projects I just mentioned. So ideally, we would bring somebody on that can help us implement and handle some of the extra processing around the new environmental infrastructure related measures that the deployment committee and the board approved last year. The next two positions are environmental infrastructure related and are associated with the rollout of our programs there. The next 4 headcount are all contingent upon us winning in something in the greenhouse gas reduction fund. We haven't specified exactly what this headcount are going to do. A lot of that's because we don't know in what way, shape, or form we are going to win. We just know that there will be a need. I think we have one of those positions is more well thought than the others. At this point, we've started to coalesce around what those needs are. That's going to be common regardless of how we are awarded funds. Some of the others are application dependent. On the program incentives and grant side, we have a cut to our budget of about $1.3 million. That $1.3 million deduction or reduction is due to us expecting to pay fewer incentives for the year. So moving on, I do want to talk through Matt, to your question, it's 2 line items that speak to that. It's the total, actually, you can see them both in the total compensation and benefits at the top of the slide. And that's a sum of employee compensation and employee benefits above that. Other questions on the budget before I talk about comp structure?
Could you just dig maybe a layer or two deeper on the anticipated cuts to the incentives in which programs?
So that's due to lower forecasts around some of the and the cleanup around the Shrek. It's also with the cutting of the battery storage. So if we're cutting the targets, we're not going to be paying as much in incentives there either.
So that was sort of, I guess, my question, because I'm seeing the separate line item for battery storage incentives where there's no change, and I'm just trying to reconcile that. I thought I assumed there would be fewer battery storage incentives, but it looks, according to this, like it's flat.
Jane and Dan, I think you guys did that calculation.
Yeah, I'm just taking a peek. Hold on.
Hi, this is Dan. Dan Smith, Associate Director of Financial Reporting. We adjusted, we do a look back for recast. We adjusted the PBIs and the EPBBs that were actually earned for the period July through November to actual. So that 1.4 million is just lower paid than what we anticipated when we first, presented the budget back in May, June timeframe.
So we aren't including any adjustment on.
We didn't adjust anything for ESS.
Okay. So
is that, this is Dominic, is that like a lagging thing where it gets expended after it's been, or should that get adjusted down?
It probably should get adjusted down. There is a bit of a lag between when we count a project as towards that target and when we pay that incentive. It will come down from this number, and we will not be paying out 1.8 million this year in battery storage incentives. So moving on to compensation structure changes, at the suggestion of one of our external HR consultants and kind of just looking at our compensation structure, we're proposing creating a new band, the band 21, So separating our executive vice presidents from our regular officers to allow for a little bit greater distinction. This allows us for a little bit more of a career path in this part of the compensation structure. We aren't increasing anybody's compensation because of this. This just allows for a little bit more flexibility in there. And then you'll note that we're moving 2 positions into this band, the executive vice president and chief investment officer, Bert, and our executive vice president for finance and accounting, Jane. Any questions or concerns as we approach the resolution?
No? Okay. Do I hear a motion to approve resolution number 4?
I make a motion. This is Rob.
Thanks, Rob. Do I hear a second?
This is Brenda, I second.
Thank you, Brenda. Okay, all in favor?
Aye.
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 Opposed? Abstaining? Okay, thanks, everybody.
Thank you.
Let's see, moving on. We're going to hear from the deployment committee, and I think this is a proposed revision to the transaction approval process for staff. It's like Mackie and Brian Farnham.
Yep. And first, I'd like to thank the deployment committee because we had a regularly scheduled meeting to present this change, and we had a great feedback. We actually had a special meeting to finalize it. So I would like to thank the deployment committee for all their help and feedback to where we are today. So a little bit of background for the entire board. We allow staff authorization to approve projects that are under $500,000. This is something that goes back all the time, all the way back to our Cephia days. Traditionally, this has been really focused on the C-PACE smaller projects that would get approved, small deals over $500,000, but the staff authorization in its aggregate cannot be over $1 million. The problem that we're running into is that with the creation and operating the new ESS program, that bucket was starting to run into issues where we would reach the queue and we would basically get to that $1 million aggregate before we got to a deployment meeting or a board meeting to clear the queue, and projects would be potentially delayed. So with that, maybe go to the next slide, Mackie, if you want to add anything, but this is some of the examples of where we've had issues with, hitting that queue and projects being delayed. And so what we wanted to do, what we went to the deployment committee and we worked through was basically creating 2 buckets, one for commercial, industrial projects, and then one for the ESS project. So the processes stay the same. The major difference is that now the aggregate is there's one for $1 million aggregate for kind of the C-PACE based projects primarily, and then one for the ESS projects. What I missed, Mackie?
No, yeah, that's great, Brian. Yeah, so we the deployment committee asked us just for some examples of the effects of having one bucket of staff approval authority, which for years was fine, as it was really just C-PACE projects utilizing the staff authority process. But now that we had 2 programs, the bucket would fill up periodically. So here's I put together this table, which is 3 examples late in 2022 and beginning of 2023, where each of the 3 areas sort of bounded by the gray is time in between deployment or board committee meetings. The black is C-PACE projects that we got in there first and were approved using the staff authority. And then you see the red lines, which are ESS, so battery storage projects that if taken as a group would have put us above the existing staff authority. So that The funds remaining column, that bolded one, the three numbers you see is sort of the how much we would have gone over if we tried to move all those projects through the staff authority. So I believe, Sergio, you can correct me if I'm wrong, I believe what they did was just wait on all of them and bring them to the appropriate or the next either board or committee meeting for approval. So as Brian said, the request is to create two different buckets of staff authority that each program would utilize, so we don't have, you know, arguably two completely unrelated types of projects influencing the ability for the other to move forward, just because of, you know, an administrative issue around staff authority. You know, on my, you know, on my end, I don't want a bunch of CPACE borrowers who are ready to close unable to do so because, you know, there happened to be a lot of battery storage program projects that were approved that month. So Sergio or Brian, unless anything to add, take any questions or turn it back to you, Chair Reed.
Thank you. Questions, observations, concerns? Okay. Do I hear a motion to approve resolution number 5?
I'll make a motion.
I'll second.
Second it, Hank.
Well, I love it. I love it. Competing to, this is great stuff. Okay, all in favor?
Aye.
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 Opposed? Abstaining? Great. Thank you. Okay, let's see. Moving on. Oh, this is going to be incentive program updates. And so Sergio and Ed.
Thank you. Yes, so we are here to request the approval of the upfront incentive for the project that will provide a battery storage for Wesleyan University. I'm sure you all are aware of this university. It's a private liberal arts, 3,000 undergrads and 200 grad students. They currently have on-site solar and they have a microgrid, and they're trying to install a 5 megawatt battery. The project, the contractor is C-Power, and C-Power will own the project. The arrangement is what C-Power refers to as storage as a service. So C-Power owns the system. They make the investment. They use the ITC and provide the battery to Wesleyan University for annual payments. Surprisingly, so the total cost of the project is $4.4 million. And under this arrangement, what Wesleyan would be paying to C-Power is less than $45,000 a year in payments. One of the things that I wanted to do here, and based on the feedback that you guys provided on during the last DC committee meeting, was to explain some of the aspects of the ESS in in greater detail. In this particular, what I'm going to do in the interest of time is cover, every time I present a project, cover a different topic. In this particular example, I want to talk about the incentives. You know, how are the incentives calculated? And it's a very simple formula. The incentives are calculated basically is the energy capacity of the battery times the applicable incentive rate. To do that, as you can see, these are the current upfront incentive levels for C&I customers. Is $200 per kWh for a small customer, $175 for a medium customer, and $100 per kWh for a large commercial customer. To determine whether the customer is small, medium, or large, we use their average peak demand. For Wesleyan University, their annual peak demand is 3.6 megawatts. We make them a large CNI. So they will be eligible for the third tier incentive, is $100 per kWh. And we simply multiply the battery, the capacity of the battery is 10,360 kWh. And we simply multiply the battery energy capacity times the applicable incentive rate. And this is the result that you get is $1 million, $1,036,000 in upfront incentive. Next slide. So, as I said, the total cost is $4.4 million. The upfront incentive is $1 million. The project is also expected to receive performance incentives in the order of $3.4 million. That is nominal terms over 10 years. And the resulting BCA ratios can be seen there. The ones that we have focused on, and Pure as well, is the RIM, is the ratepayers impact measure, is whether the incentive would be subsidized by non-participating ratepayers, which is not the case. The RIM is 1.79, where Pura has a target of 1.4 RIM for the program. It happens that this is way greater than that, meaning the benefits of the program way exceed the 1.4 target. The other one is the PCT, is the participant cost test, and this basically the benefit cost analysis for the party making the investment, right? You would think that a PCT of 1 benefits equal the cost of pursuing the project, and the customer would be indifferent. That is the point of indifference, a PCT of 1.0. In this case, PCT is almost 1.2, meaning is very favorable to the battery owner. So ratepayers are not being negatively impacted. This particular project looks great. So again, C-Power will own the battery and provide backup power and resiliency to the university for a roughly $45,000 payment a year. And next is the resolution.
Great. Just before I ask for a motion, I remember that was the first cogen plant in the country, or in, I know at least in Connecticut, at Wesleyan, and we used to take legislators there a lot to see what was going on in that arena. And it feels like it's still a good place to bring people who, when you want to show them what the stuff looks like. And now we're going to have storage. That makes it even more interesting.
That makes sense. I agree.
Okay, do I hear a motion to approve resolution number 6?
Lonnie, this is Matt. Before you get started, I'm going to
Oh,
abstain. Wesleyan's our client.
Oh, okay.
Not on this project, unfortunately.
Good call. Good call. Do I hear a motion to approve?
This is Bettina, so moved.
Thank you, Bettina. Do we hear a second?
Second, Adrian speaking.
Adrian, thank you.
You're welcome.
All in favor?
Aye.
Aye.
Opposed? Anybody else abstaining besides Matt? Okay. Thank you.
Thank you.
Let's see. Moving on. All right. So I think we're going to talk about financing programs again, some updates and recommendations. So Mackie and Catherine Duncan.
Yes, Catherine, I'll turn it over to you.
Yep, I'm here. Thanks, Chair Reed. I'm just looking at my slide. So this project is a CPACE project in Cheshire, and you all saw this project last December and approved it in December. We're coming back to you now because since then, the owner decided to reduce his repayment term from 20 years down to 5. And that required that his operating company, which he owns with his, which he fully owns, come in as a co-borrower on the property. And so the reduction in the term and the addition of the new partner on the finance agreement, we decided we'd show this to you again. So can we see, and also it's possible that the dollar amount they're borrowing is less. I'm not sure what we showed you last time, but they are not financing the deposit that they put on the system to get engineering going. So next slide, please. All right, so you can see now that it's a 5-year term. It, I think, had come in at 20 originally, so the interest rate is much lower. The ratios obviously change. You can see at the bottom with the DSCR on the property itself, it's 1.26, but with the co-borrow, it's all the way up to 3.07. Next slide, please. And on this, it's essentially Grandview Court, and now it's both Grandview Court LLC and Best Postcards, the operating company, doing this transaction. Best Postcards is a direct mail entity. Next slide, please. So the tear sheet, the changes you'll see here include possibly, as I said, I'm not sure what dollar amount we showed you, but this has been reduced from the original by his deposit. The term is shorter, the rate is lower, the DSCR is better, the savings to investment ratio is stronger, and lien to value and loan to value have changed a bit. Next slide. Same information again, just in a different table. Next slide. And the resolution to approve this loan with this new structure. So back, I think it's to you, Chair Reed. I think we're done with CPACE projects on this deal.
Okay. Anybody else want to speak on this issue, or?
Lonnie, it's Matt. It seems like good news. I'm just one question. Why wouldn't they just accelerate their payments? Why do they have to rewrite the loan?
Well, the first instance, we didn't close the loan yet. So this has happened before the closing of the loan.
Okay.
And prepayment penalties anyway had the loan closed.
Okay, so we have, I wasn't aware we had prepayment. Okay, thanks.
Any other questions or comments? Okay, do I hear a motion to approve Resolution 7?
So moved.
Thank you. Do I hear a second?
Second.
Thank you. All in favor?
Aye.
Aye.
Aye. Opposed? Abstaining? Okay. Thank you. Moving on. What's this one? I think Mackie and Elise are going to do a CPACE for resilience update. Is that correct?
Yes.
Okay.
Yes, thank you, Chair Reed. Yeah, we're finally here to talk about this. Elise, do you want me to give any overview, or do you want to jump right in? So I think we've mentioned this since the statute passed some time ago, that we've been working on implementing the statutory change to CPACE to incorporate resiliency financing into the program. So after a lot of work around this, led by Elise, we want to present the changes to the guidelines to do exactly that, incorporate resiliency. We're not looking for formal approval today. The CPACE guidelines, since they're essentially regulations, to a certain degree, statutorily are required to go through a public comment period. So, as we decided some time ago, any sort of very substantive changes to a program before they go out to public comment, we want to make sure at a high level the board's on board with the direction we're headed before we put them out there. So today we'll be giving that overview prior to putting them out for public comments, assuming a successful outcome today. So with that, let me turn it over to Elise.
Great. Thanks, Mackie. Good morning, everybody. So I did do a quick overview for you all. This is back in May of last year, so it's been a while. But Public Act 22.6, this is the change that Mackie was just referring to, where resilience improvements and EV charging infrastructure were included in the statute and were also exempt from the SIR requirement. So these are some of the changes. This is language right from the statute. The first section there is the definition of resilience. So you can see it's including but not limited to threats or incidents associated with the impacts of climate change. Of course, given our mission, that's something that we wanted to kind of point folks to. But if you read that definition, it's very, very broad. And since this is kind of a new venture for us here at the Green Bank, normally, of course, looking at energy, we wanted to try to be open and kind of understand what the market is going to look for in terms of needing resilience financing for commercial properties. So part of this, the statute says that we will work with DEEP and CIRCA to develop these program guidelines, which we did over the last year or so. And some of the requirements here of needing a resilience study and an assessment of the expected cost savings that go along with the resilience improvements. Right, next slide. So here's our approach. So we updated the guidelines and we added a new appendix, which you would have seen in your mailing. Excuse me, to cover some of the technical standards for resilience. But ultimately, what we're trying to do again in this kind of very early stages of launching resilience for CPACE financing, wanting to collect information, data from the market, understand what types of projects might need this type of financing, and identifying climate change adaptation and nature-based solution measure examples. That was really, really important. We wanted to, again, kind of make sure that we were putting those examples out there as more of a guide than anything, and making sure they were defined well. So when folks look at the guidelines, they kind of understand what the intention is. And then also incorporating a standard through through IBHS. It's called Fortified. Some of you may have heard of it. I think I mentioned it again last May. And I will get into it a little bit more in a couple of slides, but incorporating standards to access CPACE financing through the Fortified standard process. And then also indicating how other resilience measures can be submitted for review. So things that fall outside of these first couple examples that I mentioned here that may be considered a resilience measure, how those can be submitted as well. Next slide. So here's the eligibility and requirements. So on the left-hand side here in the blue box, you've got the eligibility. So standard eligibility requirements, it still needs to be a commercial property. It still needs to be in a participating municipality. And lender consent is still required. So all of the standard CPACE requirements are still there. The big exception, again, is the fact that there is no savings to investment ratio requirement, like there is for energy improvements. One of the new requirements is the resilience study. So similar on the energy side, we require that there's, excuse me, an energy audit. For the resilience projects, we require a resilience study that incorporates an assessment of the cost savings. So on the right, you've got the requirements in the green box. So we're asking folks when it's applicable to fill out a pre-study worksheet. That was one of the exhibits to the new appendix that you all would have seen in the mailing. It's meant to serve two purposes. One is to help us collect data. Like I said, we really don't know what those KPIs should be. So trying to collect some of that information from the folks that are looking to apply through this worksheet. But it's also a good way to to get folks kind of thinking of what maybe they could be doing at their property to make it more resilient. Kind of prompts them a little bit to think of some of those climate change adaptation examples that I mentioned earlier. And then a resilience study. Again, one of the exhibits in the mailing, Exhibit 2. And the exhibit kind of explains the different aspects of the resilience study that we'd like to see. Worked really closely with John and David at Circa to help with this, kind of understanding what we might want to see in a resilience study. And instead of creating a template, we decided to come up with kind of a guide for what we'd want to see in there, including a property overview and identification of the vulnerabilities. So what's happening at the property that makes them want to come to us for financing, what that proposal is for adaptation, of course, the assessment of cost savings. So showing, what the savings might be by implementing these new resilience measures, and then an implementation timeline for what that might look like, actually installing those things. And then the last thing here again, fortified. Oh, sorry, go back one more. There we go. So the fortified standard, there isn't really a set of documentation that's required. It really depends on the level of fortified that you're designing to achieve. But all of the supporting documentation, applicable forms, any backup documentation that needs to be submitted to a project evaluator, which I'll explain here in a second, all of that should be submitted to the Green Bank for approval, basically in place of that kind of standard resilience study. So we'd be able to look at that as the resilience study, of course, with the inclusion of the assessment of cost savings. Okay, next slide. So here's those examples that we were talking about, the climate change adaptation examples that we identified, as well as some nature-based solution examples. So the climate change adaptation examples, those I worked with Circa and Deep to make sure that these looked like the common ones that we see here in Connecticut, which I think we can all agree on. And then nature-based solutions worked closely with Lee on putting this list together, and also including a bit of a definition in the appendix as well. And then fortified. So just to dig into this a little bit for those that are not familiar with it, it's an IBHS program, and it is a resilient construction program. So it's very similar to, if you think about like LEED for energy, this is pretty similar on the resilience side. So it's really looking at building envelope type improvements. So windows and doors, roofs, any kind of openings that would go into the building. But that's really what it's designed for, to literally fortify the structure. Go to the next slide. It'll show you.
And I'm sorry to interrupt, Ali, just real quick. For those that aren't aware, IBHS, which is, they're the ones who govern this standard that we're using. It's sort of it's an association of all the sort of major insurance companies. So, very old, respected sort of organization within the insurance industry.
Thank you, Mackie. Yeah, so there's 3 different levels that can be achieved through fortified roof, fortified silver, and fortified gold. So this is just a quick snapshot of what the requirements are for each one of those standards. The nice thing about fortified is it can be applied to pretty much any building type. Can be used on the residential side, as well as the multifamily side and the commercial side. So pretty transferable across all different property types. And it also doesn't matter what type of project you're doing in terms of, are you retrofitting an existing building, excuse me, or are you building a new one? The standards are the same. It really just kind of depends on, if you're retrofitting a building, it's going to be really hard for you to get to fortified gold, for example, kind of, cost and construction prohibitive. But if you're looking to build a new building, likely you're going to go for that fortified gold if you're kind of starting from scratch. So it's kind of nice that it's all pretty simplified, really, across the different property types and across the different project types. Okay. So other resilience measures, as I mentioned, the definition is really broad, as we saw. So we wanted an open option for other resilience improvements that kind of fall outside of those examples to be considered for approval. So just want to note here that a resilience study, an assessment of cost savings, and all of the other requirements are still applicable. So it's still a CPACE project. You still have to do these things to be considered for approval. But again, wanted to kind of leave it open to see what the market needs are in Connecticut. And then new construction. So we of course needed to incorporate resilience improvements into our new construction appendix as well. So there's two ways that can happen. The resilience improvements can be included as bonus measures. So you'll recall now, almost 2 years ago, we updated our new construction appendix to include prescriptive measures that we called bonus technologies. All of those were very, of course, geared towards energy improvements. But we changed the name of those to bonus measures and incorporated 2 new points within that structure to allow for resilience improvements to be included. That can be included in an energy project, or the second option here is that they can use the fortified standard. And we created a new table with percentages of CPACE financing that can be accessed by designing to achieve one of the 3 levels. Bonus measures can also be included in that. Actually, if we go to the next slide, I think it's on. Yeah, there we go. So this is what we put together in terms of what percentage of CPACE financing can be accessed if you're doing fortified for new construction. So the first 2 columns there are showing you if you're designing for one of the 3 levels, kind of baseline. You'll see that there's high wind and also hurricane. That's really based on where you are located and what you need. So there's a little asterisk down there, but it's different regions essentially, and there's different equipment that's required for different regions. So those are the same levels of designation, but some would require additional equipment and potentially more expensive equipment, which is why those levels look a little bit different for financing. And then we employed the same structure that we did with the HERS rating and the whole building energy model aspects, where you get additional percentages of the TECC, the total eligible construction cost, in CPACE financing for incorporating bonus measures. And I think that's it. I'm happy to take any questions.
Yeah. Could I ask a question? This is Rob. I'm just wondering for our businesses, because going back a few slides, when looking at it, it's a new requirement for CPACE eligibility, and there's time and cost that affects this. So I was just wondering, like, what is that? Maybe I missed it. Like, what's the general time frame it takes to put together one of these assessments, and what's the cost to a business, and would that prohibit them from pursuing a CPACE program?
Well, in terms of timeline, I don't know. I don't know if I've got a good sense of that yet. We haven't quite done any of these projects yet, of course, since it's new. So I think the timeline can vary, likely pretty significantly depending on the types of improvements you're looking to install or do at the property. But in terms of the costs, that's really what I think the idea behind the using this financing is for, right? Is to, try to help allow property owners to get to a point where they can make these improvements where maybe they weren't able to before by accessing our financing to do so.
Okay.
I see Bert came off of mute. I don't know, Bert, if you wanted, or you came on video, if you wanted to join. Okay.
I did have a question. It's Adrian speaking.
Sure.
I'm very familiar with LEEDs and HERS, obviously, for new construction and even renovations in terms of measures for weatherization and healthy homes. But looking at this, I kind of wonder, this is another layer. So what relationship does this have to all the other regulations that those who are building buildings would have to seek? This is kind of a follow-on to Hoteling's question, because it's not just a question of delay and cost, but of conflicting or superseding requirements. I think it becomes quite complex. That's the first question I have. And the second question is, there's a movement in the US towards resiliency hubs, which obviously would seek to have this kind of structure because it wants to be standing or everybody else around them is failing. Is there any...
Adrienne, are you still there?
Yes? You can't hear me?
I can hear you.
Oh, okay.
Yeah, okay, good.
So it's Lonnie that has a hearing issue. Yeah, so I'm just wondering if there's any financing that you're foreseeing in terms of these resiliency hubs, because they do have to go up in our vulnerable communities.
Yes. I think there might be, maybe even Brian or Mackie might have something to add about resiliency hubs.
You want to go, Trey?
But, or Lee, yeah.
We're debating internally. Go ahead, Mackie. I'll follow up.
Yeah. I think we're pretty early in the days of resiliency hubs. My sense is, though, that a lot of those would be public buildings. I mean, maybe not, but if it is a private building that is seeking to become a resilience hub, then yeah, I think CPACE financing can be a source for helping to pay for that. On the public building side, though, just because you can't use CPACE for state or municipal and properties, then it wouldn't be, unfortunately, it wouldn't be helpful there. The resiliency hubs was one of the line items in our request for GGRF funding. So, hope maybe potentially that could be used to fund a different product that could be brought to bear there. But yeah, so I guess to keep it short, yes, in the case of when those resilience hubs are in privately owned properties, then CPACE could be brought to bear. And then Elise, on the first question around, the using fortified as a standard, do you want to speak to that?
Yeah, I think if I heard you right, Adrian, I think your question was kind of the interactivity maybe between the different standards. If a property is trying to use, one of the other energy standards, for example, and fortified at the same time. Was that your?
Yeah, and leads.
Yeah. So that's a good question. I mean, I don't know. I haven't really kind of compared. I think lead would maybe be the one that could possibly have some carryover between lead and fortified. I don't know if the HERS rating, if HERS would have any or much overlap there. but it's a good question.
The reason I bring up the HERS rating or any of the other kinds of ratings is because the Green Building Institutes across the nation are all looking at how do you standardize this stuff. And so they basically want to say, okay, you need a rating of X, but that rating of X should be standardized by doing this, 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 and this. They want to be more specific. And so the building codes and building regulations are supposed to reflect that eventually. So that's kind of why I'm asking the question, because as someone who has done a lot of building, I know how difficult it is to answer all the questions on all the different levels. And I'm just wondering about the practicality of it. And then, of course, sitting behind a desk and looking at the financing of it, it's got to be even a little more daunting at some point when you want to line that up with financial requirements.
Yeah. I mean, I definitely agree with that. And we seek with the guidelines or with CPACE to try to use existing standards rather than create our own prescriptive approach for that exact reason. Yeah, we want CPACE to be easy to access and hopefully in line with something you're already doing in terms of the analysis to qualify, just to make it easy. So like HERS, for our energy path for CPACE, we built, at least built that in the last year or two with to that exact goal. With this, I mean, we've got, this is a whole different area, sort of bucket of types of measures with resiliency. So with that goal in mind of trying to use existing standards rather than adapting our own, we sort of went out to see, what are the standards in this market. And this fortified one seemed to be the one, this is the insurance industry's set of standards. There is Brian, you might know a little more than me about this, but there's a movement within the state to try to encourage the use of fortified and bake in sort of insurance premium reductions if you're using this. So, hopefully CPACE can be a carrot to help to incentivize the adoption of that use sort of in the insurance industry in Connecticut. So I just don't, given the fact that resiliency and energy, while there are, sort of in the Venn diagram, they do, there is some overlap. They are different. So in looking to define a resilience pathway into CPACE, I don't think there's one perfect set of standards that we could use that would perfectly encompass CPACE, or excuse me, energy and resilience.
Thank you. Just something to think about as we go forward.
Yeah. See, Rob has a question.
Just one follow-up. Sorry, I feel like me and Adrian are tag teaming you guys on this, but if I could ask as we go forward, in a future board meeting, would it be possible for you to just give a compare of standards, leads, fortified, just for the board to have an understanding of that overlap? I think that'd be very helpful. And then separately, as you had indicated, Mackie, in fact, I met with Commissioner Mays over the Department of Insurance maybe a month ago, and I know they're putting together a council on coastal resiliency, and we actually talked about Hawaii and how simply a roof that was fortified helps save a building from burning down, as an example, if I recall the conversation correctly. But the point is, one is a compare and standards, I think would personally be very helpful for me. It sounds like Adrian is asking along those lines. And then separately, I was just wondering if you guys are plugged into Commissioner May's Department of Insurance's initiatives on a council for some of these resiliency standards.
Yeah, let me take the latter. We'll take the former as a homework assignment and come back on the standard comparison, Rob. On the latter, yeah, Commissioner Mays has been a super leader when it comes to the insurance industry and climate. He is now, I believe, the president of the National Association of Insurance Commissioners. And one of the things that we learned is that the insurance industry is regulated at the state level. It's not regulated at the national level. So He has learned a lot from his colleagues. His staffer, George Bradner, who we work with quite a bit, I think would tell us that the IBHS efforts and the fortified standard in other states is being recognized as a way of improving the resilience of buildings. The question then becomes, if you achieve different levels of fortified standards, could the insurance regulator require insurers to reduce insurance premiums as a result, so that there's an economic benefit for improving the resilience of properties? I think that's what's on the table for all of us. But we do have a project with the insurance department. It's called Climate Smart Technologies and Home Medical Devices for Affordable Housing. So what we're trying to understand is what technologies like heat pumps, battery storage, solar PV can make home medical devices resilient for those who reside in affordable housing. So when a disaster happens, how can we help them shelter in place? So we're coming to the end of that research project. I think we've got 6 more months on it. That project, with all the team members, which includes Operation Fuel, Yale, and the Clean Energy Group, won a federal Department of Energy $1 million grant to develop a resilient standard. So we're continuing to build the team to expand and understand this effort. And I think Fortified is going to be front and center in a lot of it, just because the insurance industry and their commissioners acknowledge it as a standard. The question for us is, if it is a standard, can we get some economic benefit from it, so that in those resilience reports that Elise was talking about, we can get some economic savings to the property owner as a result of taking those measures. But yeah, we've got great, as we all, great commissioners all supporting the governor on the issue of climate all across the board. They're everywhere, from banking to insurance to energy and environmental procurement to, you name it, economic and community development. They're all there.
Perfect. Okay.
Yeah, and
thanks, guys.
Yeah, and I mean, thank you for the guidance and sort of the push on making the program as accessible as possible, utilizing existing standards. Certain that, like, we've gotten that feedback over time. That's ingrained as we think about all these. Personally, I think it would be easiest, and almost wish we could just, especially on the energy side, just completely design a program that piggybacks on existing and widespread standards for LEED. Everyone knows LEED. I wish we could just build the program around, if you're this level of LEED, you get this financing. You get this level of LEED, you get even more. But what we have to balance that with is the SIR requirement in statute, which it does require some level of energy analysis and savings, which most of those standards just don't have baked into them. And LEED, I mean, a lot of that you can earn certification through incorporating a lot of non-energy measures. So, here when we brought the new construction CPACE energy initially on the board, that was the exact feedback we got. We went and dug in to try to incorporate that and just build it around standards, those national standards. But again, we're trying to balance it with the statutory SIR requirements, which, in this case, on the resilience side, we don't have. So we can't just completely say, just build it upon these fortified standards, which is great, and just makes it easier to access the program.
Thank you. No further questions from me. Thank you, Chair.
And Matt Ranelli did put some questions in the chat. We'll follow up with him in an email. But just real quick, for the board's knowledge, I'll run through if the SIR is greater than 1.2 does not apply, what SIR applies. There is no SIR requirement, so there's no SIR applies. The second question, how does this SIR translate for LMI incentives? I don't, Elise, do you understand that question? I'm not sure what incentives he's referencing.
I don't know.
Okay, we'll clarify that with him. And then the third, how are we requiring the recipient to ensure the in-building or work against storm, flood, and other hazards? We have, at a program level, I assume he's referencing actual insurance requirement rather than ensuring the actual building of the measures that we're financing. In terms of insurance requirements on our lending side, we have even prior to this, for any project we do, resiliency or energy, we have insurance requirements on our borrower. For other lenders, we at the program level, we don't have those insurance requirements. We leave it up to the private market to determine what, from their lending perspective, what requirements they want to put in place. But again, we'll follow up directly with Matt on this.
Yeah, that's a good idea. Okay, hearing no more questions around this at the moment.
Yes, I just want to thank you all. We'll flip this out, put it out for public comment, and then come back to you to discuss any recommended changes. We get through that and ask for your formal approval.
Great, and you can test drive it at Adrian's, anytime you need to.
Thank you all.
Thanks. I still have my driver's license, so I can test drive.
Okay, and then we want to get some updates and recommendations on the investment programs, and I'm going to turn it over to Bert. But before that, I just wanted to welcome Ben Healy back. I understand he's in the house, one of our former green bankers who's deals with the capital markets activities for Posigen. And I think he's there with Posigen's founder, Tom, I think. Anyway, we shall hear from them very shortly. But Bert, you want to kick it off?
Absolutely. Thank you, Chair Reed. So good morning. The investments team has 4 transactions we're bringing forward for approval. And as you might know from the agenda, we have 35 minutes. We're just 4 minutes behind schedule, so we'll move a pace here. Just at a high level, the 4 transactions, the first includes expanding our existing capital facility with Posigen, and a look toward the spring when we expect we will bring back to the board for approval an exciting facility with the U.S. DOE Loan Production Office. And I will further introduce, following your introduction, our guests from Posigen here in the room with me momentarily. After that, we'll consider 2 projects with Fuel Cell Energy, Liberty Bank, and another capital provider to finance a shared clean energy facility, or SCEF, and a deep competitive solicitation from 5 years ago that is now completed and ready for financing. After that, we have an existing facility with our spin-out company, Inclusive Prosperity Capital, which finances solar projects here in Connecticut. And that facility is up for renewal, so we're recommending renewal and expansion to keep up with the projects moving through our combined pipelines. We expect that to be just a short presentation since it's a renewal and a slight expansion. And finally, we have to bring to the board transactions that are restructured. This is a relatively small restructuring, and it relates to operational problems that were experienced at a CPACE project related to manufacturer's defects. So we've squared away our arrangements with the borrower, and we have to bring that to you for approval. So with that, let me introduce our 2 guests. Again, Tom Neihart and Ben Healy. Tom is known to many of you. He's the founder of Posigen, is the former CEO. I guess that makes you CEO emeritus or something. I don't know what did they give you something to?
And now officially the executive chairman.
Oh, executive chairman. Okay. Didn't mean to overlook that appointment. So, and Ben, who was on the investments team. We used to call it the finance team, but we've emerged to the esteemed title of investments since you departed, Ben. He was deputy CIO and then IPC's president before joining Posigen, whereas, as you mentioned, Chair Reed, he directs capital markets and, strategic activities and anything the board wants to throw his way, because he just seems so capable of doing just about anything and everything. So with that, let's go to that first slide here. What we wanted to do is before talking about the proposed adjustment, we wanted to review the impact our partnership with Posigen has achieved over the last few years, and it's been significant under the Solar for All campaign, under the RCIP, which did end and is now transferred to RRES, but just really considerable economic benefits and customer savings. And I know that that Brian Garcia has always had a very good way of explaining how these benefits accrue to these working families. So Brian, if you can come off mic and you want to take this slide, that would be great.
Yeah, thank you. Let me do that. And just pointing out to Ben and Tom there in the Freeman room, if you look behind you at the mural, that mural is actually Prince Street down in Bridgeport. So a couple of things to just note is that, as the board knows, we collect a lot of data. So we have, with our partnership on Solar for All with Posigen, we've got over 4,500 systems that are individually metered, so we can see the solar production. We've also got the contracts that Posigen signed with the customer, so we know the monthly lease rates. And we've also got the utility rates over time that change between UI and Eversource quarterly, biannually. Bless you, Brian. So we can see that. So the bottom curve at the bottom there is essentially, when you look at the dark blue part of the curve, those are electric rates over time. Anytime the dark blue curve is over the light blue curve is the lease rate of the solar PV systems, for all of those 4,500 for homeowners, predominantly low to moderate income families. Anytime the dark blue is above the light blue, customers are saving. What you see in 2023, when electric rates went up by 50% as a result of Connecticut's over-reliance on natural gas and the war in the Ukraine, we saw significant inflationary pressures. But because those homeowners had solar, you actually see their savings in the upper chart. So the upper chart is a cumulative savings. So when you look at 2023, actually, when you look at 2022, homeowners saved about $2.5 million over that year, which was about $550. But with the electric rates going up in 2023, we see that they saved about $1,100 with those systems. So this is really important because making these technologies more affordable and accessible to low-income and disadvantaged communities allows us not only to realize the climate benefits, but more importantly, the energy burden reduction benefits of these technologies. And that's one of the hallmarks of what Posigen's been able to do, not only with solar, but efficiency, and they're going to help lift us up with energy resilience and storage. So just wanted to put that out there. It's a data we've shared. I think, Lonnie, you and Brenda did an opinion piece in a publication on it. But just to show the board, we track a lot of data and just extraordinary performance here. Let's do more. Let's do a lot more of this. We need to do a lot more of this. Thanks, Bert.
Thank you, Brian. And with the Greenhouse Gas Reduction Fund under the Inflation Reduction Act, as well as the enhanced tax credits, adders, and everything else, for which we do have a facility that we'll mention when we get into the presentation. We're going to get a lot of tailwind, out of Washington that's really propelling the progress here. And we make sure that the public knows about these stories, these wonderful stories. You see a couple of a resident of Hamden, a resident of Milford there, but if you can, the link to this is in your board package in the memorandum. I would recommend you just listen to that and get a box of tissues, because you really will appreciate the stories of these families talk about how solar and deal with the energy burden made possible by Posigen has just changed their lives. So that's what this is about.
Made possible by Posigen with the support of the Green Bank. Every time we say it, we know what it's taken to be successful here, and this partnership has been transformative and allowed for those results. So just call it out.
Awesome. Really disappointed that you didn't wear your cape today.
That's right. I do have a Posigen cape in my office. Yeah, I should have worn it today. So here we are. To keep this progress going, what Posigen has worked out with Brookfield Asset Management. But first of all, we have a first lien and second lien facility that provides the financing against the leases that Brian Garcia mentioned that fund the solar projects that are on the rooftops, right over my shoulder here in this room. But so Brookfield has agreed to expand their facilities up to $300 million plus an adder on top of that to do some working capital funding. with separate pools of collateral. And then for Greenbank to stay lockstep with that, as you see in the lower part of the slide down below, against the borrowing base, and that borrowing base recognizes the value of the leases that are put on all these homes in Connecticut and also beyond Connecticut. But there's enough value in the more than 6,500 systems that are in Connecticut to account for our investment in the PosiGen facility. I'm going to stop right there just for a moment and see if there's any question about this so far. Oh, I do want to mention that we do have participants in the facility. So you'll notice down there at the bottom that even though we're saying we're going from the 16 million to 24 million, our exposure is represented by the very bottom line there, 9.25 million, which is where we are right now to the penny, to 17.25 million over several months. And this happens as the tranches of transactions are brought forward and they're financed by Brookfield and also by Greenbank, and we do that on a monthly basis. So with that, I'll ask if there's any questions so far before I go on to the next slide. Okay, let's keep going.
This is Lonnie, just for a second. I just want to make sure Brenda didn't have a question. I think she had something earlier. Okay, now I'm hearing it.
If that was on the battery piece, we'll come back to it.
Okay.
Okay, in terms of the risk assessment, the reason we're very happy with PosiGen as a partner here, the portfolio performance is strong. It really delivers the bill savings that Brian Garcia mentioned. There's a high and stable collection rate from its customers. For 2023, it was 98.5% of lease receivables. Consistent debt service coverage for the senior, it's about 1.2 times, and for all of the borrowings, including ours, it's 1.1 time, which is very standard for our subordinated facilities. PosiGen's capital raising activities have been very strong. Not only the expansion of the Brookfield facility, which, by the way, as I mentioned in the memorandum, will drop their cost of capital for the work in process facility by 500 basis points, which just drops down to the bottom line and to our coverages, adds cash flow to our coverage, which is great. They've also had their investors inject 30 million of capital during 2023. And this is in addition to tax equity investment, which we're generally familiar with as part of these overall facilities, $90 million from two major investors. So they're not only doing what they need to do out in the field, it's being recognized by the investment community and by tax equity, which could put their money just about anywhere, but they keep coming back to PosiGen because of the benefits not only for solar, but you could say from an overall ESG basis. And I'll stop right there if there are any questions with what we're doing. Oh, I do want to mention that down below, the only facility that is subordinated amongst all the facilities that we have outstanding is this second lien credit facility. The other facilities are senior. And what we have arranged in this proposal is for an overall exposure cap moving from 23.25 million to 25 million. So even though we're moving up substantially in exposure under the second lien credit facility, we're managing that risk by having an overall cap. What this does is this allows PosiGen under an umbrella of various facilities to use the ones that they need at a particular point in time. What they need right now, more than anything else, is the second lien credit facility, and the battery storage facility is being used on a working capital basis, but the term loans will be coming over time, and so that exposure will balance as we move forward in over the next 2 years. Any questions on that before I move to slide, which we'll talk about the DOE facility? That will be a preview of that and see that in comparison to where we are today. So let's move to the next slide, please. So what you see is what's coming down the pike. If you look at the very bottom line, we're going from 23.25 million to 25 million. Again, all the facilities are senior with the exception of the second lien credit facility. And we anticipate that once we put the CEFI facility and the DOE facility in place, that will move into a senior position alongside of the Department of Energy in a $1 billion facility. So you can see that Posigen is very smartly providing the runway that they need to keep deploying these assets in the various markets, and also dropping the cost of capital. I think that will be at least, I think it'll be approximately 300 basis points in that vicinity. What do you think, Ben?
Yeah, three conservative, 400 aggressive. So, and that's going to be across, the initial $250 million there's outstanding, and then up to the full $1 billion. So that's tens of millions of dollars a year in savings. And most importantly, for the shared value purpose, it allows us to hold or reduce pricing to the customers because we have more room to drive those costs down.
Well, it not only does that, but it allows you to stay in business.
Most importantly, it allows us to stay in business and continue to serve more customers.
The call has been. Well, I mean, it's not a minor not available.
At the tone, please record your.
Okay, thank you. It's not a minor point. There has been quite a lot of disruption in the solar business during 2023 when the Fed raised interest rates by 500 basis points. And I do want to give credit to this team of going out and finding Brookfield, moving to a fixed rate facility from a floating rate facility, lowering the cost of capital, and now progressively moving to another lower cost capital and expanded capital facility. So it really just shows you that, Ben, I don't know if being at the Green Bank had anything to do with that, but we'll take any.
We finally retrained him.
But anyway, it's
for the members of the board, we're not planning to take too much airtime here, but it is absolutely the case that the Green Bank partnership in doing it, and I say this to a lot of folks, the mentorship I got from our CIO over here in thinking through the strategy of how we serve this population that has been underserved, do the alternative credit structure that Tom envisioned all those years ago. Connecticut is now the company's biggest market, and we want to continue to double down here, and that is driven entirely by the nice things Bert said about how we're maneuvering through a tough environment in a macro sense, but also about the specific ways in which the Connecticut team has supported and invested in growth here, which now has led to, as you know, 3 offices, several hundred employees. We just gave everyone's pre-inflationary bumps that the living wages have gone up, the allocation for equity from the company. I mean, all these things just tie together to the shared mission here. And so let me shut up with that, and happy to answer questions once Bert's done if need be. But mostly Tom and I wanted to be here, not because we anticipated this to be, a tough grilling, but more to demonstrate to the board as new members have come on as well, that our commitment to Connecticut are particularly strong. And the growth here is quite exciting. So I'll leave it there.
Yeah. Okay. So I'm sorry.
Yeah. I talk to a lot of people across the country, and, my new job since I've been put out to pasture is being the face of Posigen in different places. I'll be down in DC this week. But we talk a lot about green banks and people wanting to start green banks and how green banks should function. And I tell them all that they should model themselves after the Connecticut Green Bank. Posigen wouldn't be here today if it wasn't for the support that we've received. I hear Ben mention TIB fairly often, trust in Bert. But it's made it possible for us to do the things that we do very well and to differentiate ourselves from the rest of the solar players out there. And I think that continues to strengthen us, and we'll continue to show growth in everything that we do, because we do things different than everybody else out there. And we're able to do that because of this partnership. So thank you all very much.
Wonderful. Thanks, Tom, for that, and Ben. All right. So that's what you have it. So really, we're increasing the facilities that are shown, that's actually shown struck out there in the middle of the screen, SLCF, the second lien credit facility, going to 17.25, again with an overall cap, as you see down at the very bottom, of 25 million. That's what's on the table today. The final column to the right is just for your reference. That's a peek to the future when we come back to the board. They're making their moves with the loan production office Brian Garcia and I are on the calls with the LPO every other week for updates, and we go back and forth. So that's moving along very well, and expected closure by mid-year, but we'll have to bring that to the board pretty soon. So once that's all ready, we'll be back to you and talk about shifting around these facilities with that lower cost capital. So with that, to you, Chair Reed, for any questions and to move the resolutions to a vote.
Okay. Do we hear any questions or comments? Wow. Well done.
Well, just one comment, Chair. I just think personally looking at and speaking to Bert and listening to you guys, I just think Positiv's doing a really terrific job, especially with the LMI community. So just appreciate the work. That's the only comment I want to make, Chair. Thank you.
Thank you.
And I just quickly, I should really first thank you for that comment. I asked the team this morning for updates on the battery program and ESS and where we stand. And the points called out earlier by Sergio, and then some of the members are fair in terms of the challenges. Would be happy to talk offline, but I'm happy to report we are finally in motion. We have 20 projects, all serving LMI customers that are already approved internally. We have another 20 projects that are scheduled for documentation review. So that's out of the, I think, 150 that we batteries and inventory that we purchased through the initial working capital. We'll be about a third of the way through that in Q1, which is great. We still will have to make sure we can navigate all the processes, but finally, we are making progress. The challenges have been real, but those projects are all serving qualified LMI homeowners, not just the distressed municipality bucket, as it were, but the real targets. And then I think what we're going to do to expand to the bigger, expand a little more quickly is allow our sales folks to target the distressed municipalities, regardless of whether or not the homeowner qualifies for that highest level of incentive. And again, those battery leases to the homeowners for that target category, I believe we set at $10 a month. So this is really trying to deliver again on the promise, and we'll have some learnings to report out, but we're making progress. And again, thank you for the support there.
Okay, back to you, Chair Reed.
Okay. Do I hear we're going to do resolution 8, right? Or
yeah.
Yes. Okay, good.
That's correct.
Do I hear a motion to approve resolution 8?
I'll motion, Chair. I'll second.
Second. Good. Excellent. Excellent. All in favor?
Aye.
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 Opposed? Abstaining? Excellent.
Okay,
Thank you.
we did spend a little bit of extra time there, but let's move on to FCE and the 2 projects there. And I'm going to turn it immediately over to David Beach, who's managing this project. David, are you on the line?
I'm here. Thanks, Bert.
Great.
And
Take it
thanks,
away.
Chair Reed. Yes, I know we are short on time, so I will try to move through slides quickly.
This is David. This is fuel cell energy, right? You're going to be talking about?
Correct.
Oh,
yes.
Good.
And I'll just pause at the end of each slide in case there are questions, but I will move fairly quickly. So I think Bert mentioned when he first came on, these are 2 fuel cell energy projects in Derby, Connecticut, both won in competitive solicitations. So one facility, a 2.8 megawatt facility, was won in Connecticut's Shared Clean Energy Facility Program, while the other was won as part of a deep competitive procurement for clean energy, and that's a 14 megawatt project. Both of these projects are delivering energy, RECs, and capacity to the grid, and the SCEF project is also generating SCEF credits for electric customers in United Illuminating's territory, which I'll hit on a bit later. So the total cost over these 16.8 megawatt fuel cells is $99 million. The project costs and the investments will be paid off via 20-year power purchase agreements for the DEEP project and a tariff agreement for the SCEF project. Of the 99 million, $30.2 million in a tax equity investment has been secured and closed from Franklin Park, a well-known infrastructure investor. And now we're bringing to the board term loan facility, which features a total of $9.5 million of senior loans from Liberty Bank, which will provide $6.5 million in a senior loan, and the Green Bank, which will provide $3 million. The Green Bank is also providing a subordinate loan of $3.5 million, so a total term loan facility of $13 million. Green Bank's exposure will be $6.5 million spread between the senior and subordinate loan, and comparing that $6.5 million of exposure to the $99 million of project cost, that's a private to public leverage ratio of 14:1. I'll pause briefly there in case there are any questions. Okay. Jumping into the next slide, this gives you a high-level overview of some of the terms for these various loans. So the senior loans have a 7-year term, fully amortizing, with a 1.3x or higher debt service coverage ratio. And they will be priced at roughly 7.25% interest rate. That's 275 basis points above the 7-year Federal Home Loan Bank of Boston. That is the paradigm that was used by Liberty Bank to price the Groton facility, and is being used here again for the senior loans for these projects. And then the Green Bank subordinate loan of $3.5 million will be interest only for the first 7 years, and will be supported by a total debt service coverage ratio. That's the senior loan principal and interest payments plus the subordinate loan interest only payments of 1.1x. Subordinate loan will be at 8% interest, reflecting the subordinate position in the capital stack. And after 7 years, it will be repaid in one of two options. A debt service reserve will be built up. And if at the end of 7 years, if FuelCell Energy is willing and able to provide the equity to replace the modules, restack the facility, the subordinate loan will then turn to a senior loan, with the senior loans having been fully retired. And the subordinate loan will then be paid over the next 7 years of the project, though likely sooner than 7 years, as there will be no more tax equity or senior loan. If FuelCell Energy is unable or unwilling, or if the Green Bank is looking to exit the transaction after 7 years, that debt service reserve will instead be used to fully retire the subordinate loan. Take another quick pause for questions at this point. Great. We can move on to the next slide. This is a diagram of the structure. So if we look at the blue squares at the bottom, those are our two projects. You can see the D project has power purchase agreements with both Connecticut Light and Power, subordinate subsidiary of Eversource, and United Illuminating. The SCEF project is just with United Illuminating. Both of those projects are owned by the Tax Equity Partnership, which has received that $30 million investment from Franklin Park, which you see in the upper right. The borrower, which is a subsidiary of FuelCell Energy, will receive cash flows coming up from the projects after cash is first distributed to the tax equity investor. And it's those cash flows that will be used to pay the principal and interest to Liberty and the Green Bank for the senior loans, and to provide interest-only payments to the Green Bank for the subordinate loan. Another quick pause for questions before I move on. Great. So in terms of risk mitigation, both of these projects have completed construction. We have independent engineers' reports confirming the sound building of these projects. The senior loan will be fully amortized prior to the module replacement. We're not having a module replacement reserve for these projects because we've taken some necessary steps to avoid that risk. One of them being the senior loan fully amortizing prior to that event. The other is, as I mentioned earlier, a debt service reserve that will be funded up to $3.5 million, which will allow the Green Bank to fully retire the subordinate loan if the module replacement is unable to be funded by FuelCell Energy. Again, as I mentioned above, the debt service coverage ratio, a total debt service coverage ratio in the first 7 years of 1.1, and for the senior loans, 1.3x. The security interest is a first priority security interest for the senior and a second priority for the subordinate loan on all assets of the borrower, which include its equity interest in the tax equity partnership and all of the associated collateral and assets that come with it. Unlike in previous projects, FuelCell Energy does not have to go out to the market for renewable energy credits. Those RECs are included in both PPAs and tariff agreement. So that's one risk factor that's not included here. However, both of these projects are responsible for their own procurement of natural gas. FuelCell Energy has already hedged by securing supply contracts for the first 6 years of the project. And our financial documentation will require that they stay ahead of future hedging needs by continuing to secure contracts for gas multiple years in advance of when they might be needed. FuelCell Energy will also be providing operations and maintenance. They have a world-class monitoring facility at their headquarters in Danbury, which they will use to monitor these projects as well. Both of the off-takers for the projects, United Illuminating and Connecticut Light and Power, are investment grade, the rating of A- by Fitch. And FuelCell Energy itself has provided a significant amount of equity, about $56 million. So they have a lot of skin in the game, which provides a great incentive for them to ensure these projects continue to perform well. I'll take another quick pause for any questions if there are any.
This is John Harity. I had a question. These are natural gas fuel cells. How much carbon do they save over conventional power production?
Yeah, so the figure that is often essentially quoted is the CO2 emissions is about half of what the New England grid is. So it's about half of the carbon savings for every kilowatt hour produced. We have a figure in the document. I believe it's about 418,000 tons of CO2 expected over the lifetime of these projects. So significant greenhouse gas emission savings. And these projects are also able to run on hydrogen as well.
Is there any plan in the future to bring them around to green hydrogen use?
Not as contemplated at this point. I think that will, in the end, probably depend on the price of green hydrogen being reduced to being cost competitive, as well as if there are any state policies requiring the facilities to operate in that manner as well.
Okay, thank you.
Thanks, John.
Okay, keep going, David. Thank you.
Great. So this is just a hit on the last slide, the 2.8 megawatt SCEF project. SCEF is a state program, shared clean energy facilities. It's kind of like community solar, but is technology agnostic. So for every kilowatt hour produced by the SCEF project, 2.5 cents per kilowatt hour credit is going to be provided to subscribers, with an estimated lifetime credits being distributed to 11 million. Per the statute, those credits must be distributed in the manner you see on the screen. So 20% of those credits must go to low-income customers, which are defined as earning 60% or less of the state median income. An additional 40% must go to either moderate income customers, which are 100% or less of state median income, as well as affordable housing landlords or organizations that serve low-income households, with an additional 20% being required to go to small business customers, with the remaining 20% open to any eligible customers. I just wanted to highlight this because this is a great mission alignment with the Green Bank's focus on Justice 40 and trying to ensure that the benefits of our projects are going to disadvantaged communities. I think this is the last slide before we go to resolution, so I'll pause once again for any questions. Hearing none, I'll pass it back to Chair Reed. Thank you.
Thank you. Thank you, David. Do I hear a motion to approve Resolution 9?
So moved.
Do we hear a second?
Second, Adrian speaking.
Thank you, Adrian. All in favor?
Aye.
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 Opposed? Abstaining? Great, thank you. Okay, moving on. I think this is Inclusive Prosperity Capital.
Yes, Mariana
transaction
Treef
approval.
will take this one. It's
Oh,
a
hi,
simple
Mariana. Good.
Good morning, Lonnie. Good morning, everybody. Mariana Treef here from Associate Director in the Investments team. We are here today to request a new or amended loan facility for IPC, Inclusive Prosperity Capital. Currently, we have two financing facilities with IPC to develop and finance solar PPA projects, commercial solar PPA projects, and that was entered into in 2020. One is a $5 million term loan facility, and that loan facility allows for principal to be, or for a loan to be drawn on if principal has been repaid and the principal outstanding is less than $5 million, and another $5 million construction facility, which also functions as a revolving credit facility, meaning if the construction loan is if a construction loan is paid off, that amount can be borrowed again up to that $5 million limit. To date, those two facilities have allowed us to deploy $4.8 million in funding to an IPC SPV, financing 27 commercial projects in Connecticut, equivalent to 4.2 megawatts. And most of these projects have been developed by Green Bank staff, with a good portion of those going to solar municipal projects through the MAP program. Today, what we're requesting is, having used the majority of the term loan facility, is again to enter into a new or amended construction and term facility. We're basically requesting $5 million more on the term facility, so that the total outstanding would be $15 million. The main changes that are being sort of incorporated in the either new or amended, and I keep saying new or amended because we're in the process of engaging with council and trying to understand what is an easier path forward, is allowing for the ability to have flexibility in terms of how IPC will monetize the ITC, if it'll continue to be via a tax equity partnership flip, which is what has been done up until now, or allow them to also either sell the ITC or claim the ITC through direct pay, both of which are new ways in which the ITC can be monetized with the passing of the IRA. There's also a few other changes to allow for like the changing environment, such as interest rate, and given that the sale of the ITC or direct pay and the way those are monetized, the timing is a little bit different than with a tax equity partnership flip. The facility will allow IPC to draw on those funds, including sort of the expected ITC, and repay them once those have been monetized, either through a sale or through direct or elective pay. So those are the biggest changes. And with that, yes, you can go on to the next slide. I would like to ask or call for a resolution unless there's any question. Rob, I see your question.
I see Rob has a question.
Yeah, very, very good question. Can you go back to the prior slide? Just wondering, what's the utilization of the financing, the construction financing facility, the revolving credit? I understand you're 4.8 to date, finance these great projects. You're looking to increase the loan facility, but what's unclear to me is the construction financing revolving credit facility. What's the utilization there?
The total amount that it has been utilized has been low, about $2 million, but we still want to have that one on there to allow for IPC to draw on construction if needed. And that one is a revolver. So as projects sort of move from construction to the term loan facility, that is paid back and then drawn again.
Okay, so that's the justification for keeping at it. in my mind, I'm thinking you're asking for more money on the loan facility, but if you're underutilizing construction, then we could reduce and overall but what you're saying is you still need that room on that facility in order to make sure that we can properly leverage it for various projects. So I understand. Okay, thank you.
Exactly. So that the next 5 million of financing under the term facility, you can draw on the construction, get repaid, and et cetera. So it's a size that's worked well.
Okay, thank you. No further questions, Chair Reed. Thank you.
Thank you, Rob. Okay, any more questions? Anybody else? All right, that brings us to resolution 10. Do I hear a motion to approve resolution 10?
I'll move. So moved.
Thanks, Rob. Do you hear a second?
Second.
Thanks, John. Okay, all in favor?
Aye.
Aye.
Aye. Opposed? Abstaining? Okay. All right, moving on. I think we're going to discuss the Bausch project, and that's Bert and Desiree.
Yes, very briefly. And Desiree Miller, are you on the line? You can just quickly walk through this. This is really a minor, but go right ahead. Thank you.
Sure. Thanks, Bert. So this morning, I'm going to walk everybody through the restructuring of 3 different contracts that the Green Bank holds with Bausch. Next slide, please. Can you advance the slides?
Yep. There we go. Oop, nope. One back. There we go.
Oh.
Sorry.
Sorry.
It's on that slide where it has under production and repair history. So you can just speak to it.
Sure. So we have 3 separate contracts with Bausch, 1 solar lease and 2 CPACE contracts. Next slide, please. So the solar lease facility began to show significant underproduction, which after a lot of diagnostics was determined to largely be caused by Trina modules. Getting Trina, which is a Chinese-based manufacturer, to replace hundreds of modules in the middle of a pandemic was quite a slow process. There were delays with manufacturing. It was a vintage size module, delays with shipping, and just a ton of diagnostics that they required to essentially give us what was a pretty expensive for them replacement of modules. The silver lining for us as the Green Bank is that the cost of removing and replacing the modules and as well as the diagnostics was covered by a combination of Trina through their warranty process and also through our assurance policy. Next slide, please. So during that protracted repair process, Bausch, the customer, became frustrated and decided to withhold payments not only on the solar lease, which was underperforming, but also on solar CPACE and energy CPACE contracts. So as you can see in this table here, they haven't paid us since July 2021. Next slide. So we are proposing to restructure the 3 contracts. Step number 1 would be converting the solar lease to a power purchase agreement. This would bring Bausch's contract up to today's contractual standard, which is the PPA. We haven't signed a solar lease of this solar equipment lease of this structure in a few years. And if the system performs as expected, which it currently is post-repair, we would be receiving the same revenue of $11,400 semi-annually. We would also waive 1 payment of $11,400 to compensate Bausch for underproduction. And then 2 measures that we are proposing on all 3 contracts are extending the payment terms equal to the number of payments not made, and also waiving all late fees. Collectively, these 4 measures would cost the Green Bank $70,000 over the 3 contracts' lifetimes, and that essentially these measures are meant to compensate Bausch for underproduction, acknowledge their negative customer experience, and avoid litigation with Bausch. On to the next slide. Here are the resolutions. So if anybody has questions, I can take them, or Brian or Bert.
Okay, back to you, Chair Reed.
I see Rob. Rob has a question.
Okay.
Yeah, sorry. So what's unclear to me is I understand our exposure now would be 70,000 on these 3 contracts and you're converting to PPA, which is our new standard. So, but what was the net negative here? So we're really going to be avoiding potential litigation, which may cost a lot more than the losses here. Do I understand that right?
That's correct.
This is risk mitigation, essentially.
Yes, this is Brian. This has been a long, protracted experience. It's been very difficult to work with this owner. You know, these are his buildings that he owns. You know, it was his baby. He's very. It's been a very. I've been working with their counsel, who's outside counsel. We're at the point where it's either this settlement, or we're basically suing them.
Yeah, I understand. So this makes sense to me. Okay, thank you. No further question from me, Chair Reed.
Thank you. Anybody else?
Yeah,
Okay.
I think
I
John
had
Harity had a question.
I just briefly, what is a Trina module, and does this extend beyond these installations?
Yeah, Trina's one of the manufacturers of solar panels, and this same issue, this what voltage to ground issue is, we are seeing it on other systems which have the same model of module, and we're going through the warranty process just the same. But luckily, this system, for whatever reason, seemed to underperform before, significant underperformance on the other systems, so we can be more proactive. We've identified the problem, and then we looked at the other sites that have the same product on them. So we're going through the warranty process to replace them.
Thank you.
Okay.
Chair Reed, I'm sorry.
Rob again?
John asked an incredibly important question. I'm sorry, John, that's the right. So based on what he just said, how systemic is this with Trina and these Chinese modules? How many projects have Trina? What's our risk there, wider wise?
Yeah, it's not all Trina sites. It's just ones that have this specific run. I think it's around 5 or 6 sites. I don't know exactly, but it's not it's not huge, and we're on top of it, and we're already, you know, the panels have been tested. The warranty process is, you know, started.
Yeah, the process, Rob, is well known to us, and we're just working through it step by step. We're not concerned about it.
Okay, so it's a low risk that it's systemic beyond this. Okay.
Net.
Okay, all right, thank you.
Okay, anybody else? Do I hear a motion to approve Resolution 11?
So moved.
Thank you, John. Do I hear a second?
I'll second.
Thanks, Rob. Okay, all in favor?
Aye.
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 Opposed? Abstaining? Great, that's our final resolution. Fabulous, we made it through. And now we're going to have some updates that hopefully people will stay around for if they can. James DeSantos is going to tell us about what's going on with the legislative process. James?
Thank you, Chair Reed. Hello, everyone. James DeSantos, Legislative Liaison. Just wanted to walk you through this very briefly. I could probably do it in about a minute and a half. Unfortunately, the February one will be a lot longer. So the regular session starts this year on February 7th, adjourns on May 8th. It's a short session. Typically in a long session, you have about 5 to 6 months. In short session, you got a little over 3 to 4. But what happens is they take 2 months off the length of the session, and they double the amount of bills they put into it. So it's very, very, very fast paced. At this point, I only have very high level talking points. It's not that we weren't able to get a hold of language pertaining to a lot of these issues that we are involved in. It's that they haven't been drafted yet. So the first is the Hydropower Task Force. As you may remember, it was established by a piece of legislation in the last in the 2023 legislative session. Mariana has been appointed to represent the Green Bank on that. Their goal is to develop recommendations and proposals to incentivize existing run-of-the-river hydro facilities here in Connecticut. They were supposed to report in February. I believe there's efforts to move that reporting date out to March. So we'll have more to report on that in February or March of this year. The NRES expansion is a major issue this coming legislative session. Last year, there was a very brief glimpse of an effort to expand the NRES from 100 to 200 megawatts. Already this year, the Representative Steinberg from the Energy and Technology Committee basically said he wants to try to introduce a moratorium on the NRES cap until all the federal funding is exhausted. He wasn't optimistic that he'd get that, but I can assure you that the 100 and 200 or something in that area will be back. The other one is the uniform solar tax. So this was also a bill that was in the last legislative session that unfortunately failed. It did two things. It basically clarified language for our buy all, sell all solar projects throughout the state. Some tax assessors are interpreting the language as on-site commercial industrial purposes, as the buy all sell all is you're selling to the grid. So they're not deeming that as a behind the meter installation. So that is a issue that is starting to pop up throughout the state. There is a commitment to address that issue. Unfortunately, last year it was tied to the uniform capacity tax, which was to levelize the playing field for large scale solar. Anything over, I believe, 2 megawatts was going to be taxed at $8,000 per megawatt, regardless of the location throughout the state. So it took the mill rates out of the play, which means you would stop seeing the growth of solar all in Eastern Connecticut and you start seeing it in congested areas on the west side of the state. So we're going to see different forms of that. The Green Bank did draft legislation, submitted it to OPM and the governor's office as a fallback that addresses the buy all, sell all issue only. The uniform capacity tax was contentious. So if that happens to drag the bill down, at the very least, we can get the clarification through. The next one on here is the heat pump expansion. As everyone knows, I mean, Governor Lamont signed a pledge in September of last year on the U.S. Climate Alliance to quadruple the amount of heat pumps in the state of Connecticut by 2030. There are many groups up there, especially led by the Sierra Club, that are pushing efforts on this. DEEP, OPM, the governor's office, the Green Bank, we've all met and will continue to meet to make sure that we have a sound program and goal set by the end of this legislative session. The Environment Committee is interesting. They have a omnibus bill right now, which is being led by their Vice Chair, Christine Palm. Right now, it has 12 sections. It brings in everything from the NRES expansion, which energy is going to take care of, uniform capacity tax, which energy as well. They're looking to expand SCEF and modify it. The SCEF program is our community solar program and set to expire in 2025. They're looking to expand that. What modifications are unknown at this point. Again, the heat pump deployment is going to be a major issue. And also the zero carbon schools, which was the Connecticut Roundtable on Climate and Jobs legislative proposal in the last legislative session, which was Senate Bill 961. A version of that will be incorporated into this omnibus bill as Section 11. We have not seen the language on that. The other sources that we know that are coming down the pike is the governor is going to be introducing a bill on climate. The Green Bank drafted language for resiliency improvement districts. That will be incorporated. We have not seen the final language on that. So hopefully we'll see that in the next week and we can discuss it in more detail on the February board meeting. There is mentions of updating the municipal plans of conservation and development to tie it more closely to resilience efforts and climate change. And then we also know that the Department of Consumer Protection is putting out a solar bill of rights to address residential solar installations throughout the state, assuring that, you know, warranties and everything are made very clear, and the long-term operations and maintenance contracts are very clearly laid out and identified throughout the term of the PPA. So that's all I have there. And I would just encourage, I know you're going to see pop up throughout the state. Any organization with 2 or more people is going to have a legislative agenda. If they put it out there and you have questions on it, just please give me a call and I can tell you where that agenda is going to be rolled into, because it is a short session. There's no individual proposed bills. They're all committee bills. So everything's going to be put somewhere. So just please reach out and I'll let you know. And Farnham,
Okay,
yeah.
James, I see that Hank has a question and also John Harity, but let's go with Hank first.
Okay.
Yeah, mine's really quick. I just want to reconcile. You said a moratorium on the NRES cap, and I just want to make sure that, because the slide says just a moratorium on NRES, and so I just want to.
Yeah.
Those are different directions.
Thank you. That is very, very
sure.
important.
Yeah.
Yes. Yeah. Thank you, Hank. Yes, it is the cap, which is currently 100 megawatts a year.
And John?
Yeah, I had a question about the heat pump. Will that include heat loops? Which is a sort of a new way of doing like neighborhood heat pumps.
This is Brian. I think that would be kind of a separate technology. I think of like what's going down and with down in Bridgeport and things like that. I don't think that would fall in that bucket. It's my best guess.
Yeah, I would have to agree with Brian on that. There's been no reference to that.
Yeah, I just found out about it at this conference in New York, and it seems as though it's really a promising new way of doing this, covering a lot of homes at once at much less cost.
So there's 2 loop ideas. There's like the Bridgeport thermal loop that's using the waste excess heat, but there are ground source heat pump technologies that can be put together in a loop. So I think, you know, I think ground source heat pumps have a bright future in Connecticut.
Okay. I think it's as we all know too, or should know, it's also an election year, so that's going to pump up some of the emotional interaction as we go forward, and it'll be good to see what's going on in districts on who's, you know, popping up to run against this one or that one and what their issues are going to be. So that could be very helpful information. All righty.
I wanted to add one thing. I had met with my Representative Anderson, who I think is the ranking minority member on environment, and he kept talking about. He kept asking me what I thought about nuclear. So I don't know if they're thinking about introducing any legislation on this, but he just kept bringing it up about whether I thought nuclear was renewable and should we be looking at investing in that again? Just FYI.
Yeah, no, I would just say, I mean, Representative John Steinberg brought that up yesterday about small nuclear modular reactors, and so did Representative Callahan. And I believe there was a task force that was established, and I probably refer to Hank on this one, that was established in the last legislative session to come up.
And just for everyone's edification too, the Green Bank, we cannot finance in the nuclear, as I am. It's the opinions of Brian Farnan only. I love nuclear to address climate change, but we can't have any role in that space.
Yeah.
Yeah, we have someone at DEEP who used to run the plant at Millstone, who's I think representing us on that effort. And I'll just say, you know, nuclear is not renewable, but it is carbon free. So.
Okay.
All right. Thank you.
Thank you. And I think, let's see, we're going to do some updates on residential renewable energy solutions with affordable housing. So that's Mackie and Emily Basham. Hey, Emily.
Hey, good morning. We've only got 14 minutes left, and I believe that we've got 2 updates. So I'm going to really go through this quickly. I apologize for just constraining it. Please cut me off if I'm going over anything you want to dive in on. Go on to the next slide. So I'm going to talk about all the work we've done over the last few years from a legislative, then regulatory, and then sort of program and financial product design to put us in a position now to hopefully really start to scale solar and storage deployment in the affordable multifamily sector. Go on to the next slide. So 2 years ago, a legislative change was made, the Green Bank working with DEEP to address two of the fundamental barriers to deployment in this sector, which it seems like a small change, but we switched affordable multifamily from non-residential to residential. You can go to the next slide, which did a lot of things. It addressed the first barrier. I mentioned there were two. The first is just cost and previously having to compete for incentives against every commercial project in the state. As a residential property, the incentive is higher and there's no competition. It's an uncapped program. So that helped with the economics of a project. And then the second problem or barrier in the space was even when there was deployment, it was all benefits were going to the property owner. These were projects built behind the common area meters, and all the solar savings were going to the property owner. So if we were going to do the first thing, increase incentive, we wanted to do it in a way that got benefits to tenants. So the statute allowed one project to be built that was large enough, didn't have to just serve the common area space. It could be large enough to produce enough power for all of the meters on the property. And in exchange for that, part of the benefits had to be shared with the tenants. Next slide. I won't go into the details here, but the first question was, all right, well, affordable multifamily qualifies for this special treatment. What is affordable? There was a regulatory process at PURA, which working group that PURA created, which consists of us, DOH, Department of Housing, the Connecticut Housing Finance Authority, CHAFA, and DEEP are a part of. We made recommendations to PURA for them to utilize this authority the statute gave them to create, although it looks complicated here, an easy framework for solar developers and property owners to navigate in terms of qualifying in. What it resulted in is essentially a list of just over 1,300 properties that are eligible to participate in the program. There's other pathways in to qualify, but we've got a starting point here with 1,300 that are automatically qualified based on their participation in state and federal affordable housing programs. Next slide. All right, so we've got the who qualifies, and we've got what they qualify for, which is as a residential customer. So what does this mean? So those projects get a buy-all tariff under the RRES program of just over 37 cents, which, just to sort of ground that for you, previously these projects, as I mentioned, were commercial projects. The highest compensation you could get in that program was around 20 cents, and larger projects were getting less. So this is almost double the best you could get under the old program. So that makes the economics obviously a lot better. And these tend to be more expensive projects, so it makes a lot of them feasible. And in terms of the other point I made, like the tenants have to get some of that benefit. With input from the working group, PURA determined that at least 20% of that tariff has to go to the tenants in the case of tenant metered properties. So that means all the tenants are going to get credits on their electric bill for their portion of the tariff. For master metered properties, it's a little more complicated because obviously there is no tenant electric account. There's just one that the property owner pays. PURA hasn't finalized this yet, but they have a proposal that in that case, at least 25% has to go to the tenants, and they receive that benefit in the form of an improvement to the property. This would be something like new appliances. Most of them are energy related that Pure has recommended. This would be something like appliances or heat pumps or something like that. So again, still some more work to do, but on that front, but on the tenant metered side, we've got a great state policy structure here to deploy projects. Good level incentive makes it attractive for the property owner, and still good benefits for the tenants, which they don't have to do. They don't have to buy into the project. They don't have to contribute money to the property owners to support it. Just by nature of being in a building that has solar on it, they will see a reduction to their electric bill. Next slide. We've talked about this a lot, but luckily for us, is all the state policy is coming into play. The Inflation Reduction Act passed, which made all these investment tax credit adders, a lot of them focus on low-income housing available. This is only going to make these projects more economically attractive. So, you know, we're very focused on making sure this federal money is brought to bear in these projects. Next slide. All right, so we got federal incentives available. We've got this great state policy structure in place. How do we actually make projects happen? So what we plan to do is expand our very successful solar marketplace assistance program into the affordable housing space. Financing, as it is in other sectors, is a barrier, but it's not the only barrier, especially for properties such as this, where you've got to navigate companies. We just went through the tax credits. There's layers of things you have to maneuver through, rules and applications to access those. There's choosing contractor, just all the barriers to getting a project done. Solar Map comes in and provides assistance from every step of the way. Technical feasibility, contractor procurement, incentive procurement, and in the end, financing. So, we think this will allow us to quickly scale deployment in the sector. Next slide. And then we developed a new financing product to the sort of tailor-made for this program and this sector. So this is we think a solar and storage lease would be the most attractive to properties like this that tend to have a lot of complicated financing in place. Taking on additional debt is quite tough. So the lease is essentially a revenue sharing structure. The Green Bank pays 100% of the cost for the solar and the storage. We own the asset, we maintain the asset, we bear the risk and all the O&M requirements. In exchange for that, we take a portion of the buyout credit. The tenants get their 20%, and then the property owner gets whatever's left. So, from the property owner perspective, they get solar on the roof. If they want, they get a battery to provide resiliency, no cost, no risk. It's just opening up a new revenue stream for them, again, without having to take on any debt. So we think the value proposition is very good and will be very attractive in the space. Next slide. So I just wanted to provide an example of what this could look like when you put all those pieces together. We've been talking to the New Haven Housing Authority about a property that they have. They have a contractor that we've been working with. We've scoped it out, put some numbers in place. So just we'll first look at just if they just did solar. One of the key variables here, as I mentioned, is those federal money. So if you get just the base ITC, the 30% you see here, the property owner is going to get over $12,000 a year. The residents are going to get, this is about a 100-unit property, they're going to get $235 a year. If we are able to access those additional federal incentives, get up to the 50 cent, you can see the impact that has. And the property owner is getting more than double than they're getting at the 30% ITC. So just, again, the impact of these federal incentives is huge and really will allow us to make what's a great state structure, great policy structure, even more attractive. And you see it also increases the tenant portion as well. when you add in storage to this, the solar is essentially subsidizing the storage. So you see the revenue for the property owner coming down, but in exchange for that, they are getting the resiliency. The residence remains pretty similar because again, they have to get the 20% of the solar revenue no matter what. So again, this is just one project, but this is around the average size that we're seeing in this market, maybe a little bigger. So would expect the economics of a lot of projects to be similar to this. So yeah, so we've got all the pieces in place. The final big pieces were to get the team, the MAP team in place. So, you know, Emily Basham has done a fantastic job in the state and the municipal sectors running that program. It's been a huge success. And she's brought on a new hire, Katie Shelton, who was previously with Verigy, which is one of the premier solar developers in the state. She was one of their premier solar project developers. So we're very excited to have her. So I think with that team, this program, this lease in place, will really be able to hopefully hit the, you know, I know the board has expressed over the last few meetings a desire to really start to see things happen in the space. So I think with all these pieces in place, and I didn't even mention the greenhouse gas reduction fund, if that money comes in, that's going to make all this even more attractive. So really excited about the opportunity here and looking forward to starting to get some projects done. All right, I'm almost out of breath from talking so quickly and going through so much. Sorry, I went a little long, but happy to take any questions.
I see John has a question.
Is this only for multifamily, or do single, like homeowners, do they get these benefits?
Our product and program is only for multifamily, so 5 units or more. That was defined in statute. However, single family homes, I mean, this is the residential solar program for the state. So they are eligible for RES. We don't have a third, but we've got Posigen, you know, our investment in Posigen, they can deploy solar and storage projects by accessing the incentives available here.
Thank you.
Any other questions? Okay. And I think we're going to conclude with Sergio again, who's going to just give us a quick sense of Puro's decision on energy storage solutions. Sergio?
Yes. Hello, everyone. So I have 1 minute. Let's try to do this. So in this slide, I'm trying to show the status of the program. On the top of the chart, you can see the residential statistics. At the bottom is the non-residential or the CNI statistics. Two very different stories. On the resi side, you can see of the 50 megawatts in tranche 1, we have approved only 2.6 megawatts, roughly 5% of the available capacity. Of those 2.6 megawatts, 1 megawatt is already in place, have gone online. That is roughly 2% of the available capacity. What this tells us is, well, is the little interest that is the RESI program, the RESI portion of the program is experiencing. However, these are projects that because of their size, they come online fairly quickly, right? Of the 2.6, 1 megawatt is online. That's roughly 40% of all projects are online. At the bottom, you can see the non-residential portion. You may recall in March, in March of 2023, we ran out of capacity for the tranche 1. We had to open tranche 2 capacity, the 100 megawatts that was supposed to open in 2025 and last until 2027. We have, as of December 31, we had approved 75, north of 75 megawatts of capacity. very strong interest in the non-residential portion of the program, given the very generous incentives. However, as you can see in the purple bar, only 0.1 megawatts of those projects have come online. It's a very small CNI project. It's 125 kW, and this shows the problems we're experiencing in the interconnection queue. Because these projects are much larger, it will take a few years to come online. So that's the status of the program. And the last slide is what happened in this year 3 review, the changes from year 2. We were able to increase the underserved communities and low income incentives by 50%. Underserved went from $300 to $450 per kWh. Low income went from $400 to $600 per kWh. We also were able to get a raise on the incentive cap, initially set as $7,500, which was roughly 50% of the expected project cost. We raised it to $16,000, which is now roughly 50% of the project cost. Mackie alluded to this, multifamily affordable housing. It used to be considered underserved, or it was qualified as underserved community. Now they qualify for the low income adder or the low income incentive, which is, give them access to much larger incentives, and presumably will allow us to deploy more systems in multifamily affordable housing. And last but not least is the cost recovery mechanism. Up until now, we were required to cost recover actual costs, and in this final decision, PURA allow us to cost recover based on estimates, meaning we're reducing the time that it's going to take the Green Bank to recover the administrative costs. That's all I have. Is there any questions? If not, thanks everyone. Charit, back to you.
Thank you, Sergio. John, is that your hand up, or is that a hand up for another question?
It was just left up.
It was just left up. Okay.
Yeah. But I would make a motion to adjourn if that was in order.
Oh, thank you. Do I hear a second?
A second.
Thanks, everybody. Everybody have a great weekend. We adjourn this meeting.
Bye.
Thank you.
Bye, everybody.
Thank you all.
Bye, everybody.
Bye-bye.